The most dangerous word in finance is not crash, it is stable. When people hear the word crash, they get nervous. They start looking for sirens, headlines, red numbers, men running out of buildings. That kind of danger at least announces itself. It gives your instincts something to grab. It lets you feel intelligent for being afraid. But the danger that ruins more people is the one that arrives wearing a calm face. I have watched this movie for too long to mistake a smooth surface for a sound structure. When a market tells you that it can deliver high yields, low volatility, tiny reported losses, customized lending, and patient capital all at once, I do not feel impressed. I feel hungry. I start asking where the trick is, because somewhere inside that polished machine, somebody is swallowing a risk that other people have chosen not to look at. That is what private credit has become. People dress it up with elegant language. They call it direct lending. They call it bespoke capital. They call it the democratization of alternative assets. They call it an illiquidity premium, as if the inability to get your money back is a refined lifestyle choice. I call it something simpler. I call it a locked door machine. And if you do not understand that machine, you should not let your retirement walk into it. The pitch sounds intelligent because it is built on a real historical fact. After 2008, regulators pushed banks to hold more capital against risky loans. Banks pulled back from parts of the lending market that had become less attractive under the new rules. Into that vacuum stepped private funds, private equity sponsors, alternative asset managers, business development companies, feeder structures, and all the other creatures that thrive whenever the regulated system decides not to touch something with bare hands. At first, the story sounded almost noble. Long-term investors like pensions and sovereign funds were told they could lock their money up, lend to middle-market companies, earn a healthy yield, and avoid the day-to-day panic of public markets. No depositors would show up demanding cash at once. No trading screen would force a public price on every asset every afternoon. The borrowers would get flexible financing, the investors would get better returns, the managers would get fat fees. Everybody smiled. I do not trust smiles that wide in finance. When a structure looks unusually peaceful, I ask whether it is truly safer or whether somebody simply turned off the alarm system in private credit. That distinction matters more than almost anywhere else. Public markets force embarrassment quickly. Private markets can postpone it. Public markets mark pain. Private markets negotiate with it, rename it, move it to another drawer, or carry it at a value that makes everybody feel more spiritual than informed. That is why the locked door machine is dangerous. It does not merely take risk. It alters your perception of risk. And once perception has been altered, ordinary people begin to make extraordinary mistakes. You need to understand what is actually sitting inside this machine. Much of private credit is lending to companies that are too small, too levered, too cyclical, too sponsor dependent, or simply too awkward for traditional bank balance sheets to love. Many of these businesses are owned by private equity firms that use substantial leverage as a normal part of life. They are not borrowing because their balance sheets radiate purity. They are borrowing because money has always been willing to flatter a story in good times. Then rates rise, margins tighten, the economy cools, energy costs move the wrong way. Inflation refuses to behave, and suddenly the same loans that look sophisticated in a zero-rate world start looking like wet cardboard in a real one. That is the part the sales brochure never emphasizes. Yield is not free. When somebody offers you more of it, you are not being blessed, you are being handed responsibility. If you do not know exactly what responsibility you just accepted, then you are not an investor. You are inventory. I want you to sit with that sentence. If you buy what you do not understand because it was offered by someone wearing a tie, speaking softly, and charging a commission, you are not practicing capital allocation. You are volunteering to become product flow. That is what makes this market so revealing. It tells you who is thinking like an owner and who is still behaving like a customer. Owners ask how the cash flows survive stress. Customers ask what the current yield is. Owners ask where the exits are. Customers ask how often they get paid. Owners ask who benefits if valuations are generous. Customers ask whether the brochure says monthly income. The locked door machine feeds on that difference. For years, private credit enjoyed the glow of a miracle. Funds advertised double-digit returns with almost no reported losses. Some boasted default and loss numbers so low they would make an old-fashioned banker blush. That sort of performance always attracts worshipers. Pension funds wanted yield. Insurance money wanted yield. Wealth managers wanted yield. Clients wanted something that sounded richer than an index fund. In a world starved for return, smooth numbers start to look like proof of genius. But smooth numbers are often just proof that nobody is forcing honesty on schedule. If a public bond breaks, the market tells you today. If a private loan weakens, the manager may still tell you tomorrow looks fine. If a borrower cannot really service the debt, the lender may call the problem temporary. If collateral has been pledged twice, nobody may notice until bankruptcy drags the file cabinet into daylight. If a company should be written down, the manager may decide it merely deserves patience. If cash interest cannot be paid, the unpaid amount can be added to the loan and renamed as though accounting vocabulary can restore economic substance. I have seen investors confuse delayed recognition with safety more times than I can count. It never ends well. The most instructive failures in any credit cycle are not important because they are unique. They matter because they reveal the habits that were already there. A company collapses and suddenly lenders discover debt they did not know existed. Collateral turns out to have been promised to multiple parties. New loans were used to pay off old loans' distress. That should have been recognized as loss was recycled long enough to preserve appearances. Investors act shocked, but the real shock is usually that they let themselves believe a system could produce premium returns with almost no premium pain. That is not investing. That is moral laziness wearing a spreadsheet. And once you understand that, you can see why the locked door machine works so well on the human mind. It flatters your desire to believe that complexity is protection. It flatters your desire to believe that private means superior. It flatters your desire to believe that what cannot be priced daily cannot hurt daily. It flatters your desire to believe that someone else has performed the hard analysis. It flatters your desire to believe that illiquidity is a mark of sophistication rather than a forfeiture of control. In other words, it sells status and sedation at the same time. That is a lucrative combination. Now, the machine is changing, and that change tells you everything. For a long time, the big money behind this market came from institutions that at least understood they were buying something illiquid. They could lock capital away for years. They had teams, they had mandates, they had enough size to negotiate. Even then, I did not assume they were always right. Big institutions are perfectly capable of doing dumb things in formal language, but at least they knew they were boarding a ship without lifeboats. Retail investors are different. Retail investors are being invited into the same waters through wrappers designed to feel friendlier than the underlying assets actually are. That should bother you. Whenever Wall Street starts saying average savers deserve access to the same opportunities as the giants, ask one simple question. Why is this generosity arriving now? I will tell you why. Because when sophisticated capital becomes more cautious, the product must find new buyers. That is not democratization. That is distribution. And distribution is where the conflict of interest becomes obscene. Many of these private credit products are not bought in the way a good business is bought. They are sold, they are pushed through advisors who can earn commissions that make a plain, honest ETF look almost insulting by comparison. If the incentive system pays somebody far more to put you into an opaque illiquid product than into a low-cost public market fund, do not insult yourself by pretending the advice is automatically pure. Incentives are never decoration. Incentives are the script. I have spent my life watching incentives because they explain human behavior faster than speeches do. Show me the commission structure and I will show you the pressure line running underneath the recommendation. Show me the servicing fee and I will show you why a complicated product suddenly became a noble necessity for your retirement. Show me a manager who gets rewarded for keeping marks high and withdrawals low, and I will show you a man with a deep interest in calling ambiguity stability. You cannot afford to be sentimental about this. The great divide in money is not rich versus poor. It is owner versus outsider. The outsider is always the last person to discover what game is actually being played. The outsider sees the yield after the structure has been built. The owner sees the structure before the yield is advertised. The outsider is impressed by access. The owner cares about control. If you hand over control for the privilege of hearing a nicer story about yield, you are moving backward, not forward. The most important lie in this part of finance is the word liquid, with an asterisk attached to it. Some of these vehicles market themselves as semi-liquid, quarterly liquid, orderly redemption products, or other phrases designed to soothe you into believing the door exists because the brochure includes a handle. But liquidity is not a decorative feature. Liquidity is either there when fear appears or it never existed. In the form you imagined, you do not discover whether a door is real by looking at it in a quiet room. You discover it when the building catches fire. And in private credit, many investors are being sold doors that only work when almost nobody wants to use them. A fund may say redemptions are offered quarterly. Wonderful. Then you read the plumbing. Withdrawals are capped at a small percentage of the whole fund, not your holding, the whole fund. If requests exceed the cap, you do not receive your money because you would prefer it. You receive your ration because the gatekeeper says that is all the machine can tolerate. And once investors understand this, the psychology becomes ugly in a hurry. If I know the gate may close, I have an incentive to ask early. If you know the gate may close, you have an incentive to ask early. If everyone knows this, the rational behavior becomes a run toward the gate before the official word run is ever used. That is how a structure designed to look stable creates its own instability. The moment investors doubt that liquidity will be available later, they request it sooner. To meet those requests, managers are often pushed to sell the cleaner, easier, more liquid pieces first, because nobody wants to crystallize the ugliest losses if it can be avoided. What remains in the vehicle becomes a worse and worse mix. The good apples leave early. The bruised ones stay in the basket. The remaining investors are trapped in a structure that grows weaker as confidence weakens. This is not an unfortunate side effect. This is the machine revealing what it always was. I want you to notice how many things in modern finance rely on the same psychological trick. They sell you yield now by borrowing from your future freedom. They sell you convenience now by taking away your refusal power later. They sell you stable marks now by delaying honest discovery. They sell you access now by hiding the locked door behind the wallpaper. That is not wealth. Wealth is control. Wealth is the ability to say no. Wealth is the ability to understand what you own, when you can exit, who is paid to recommend it, how it behaves under stress, and whether the accounting reflects the economics or merely decorates them. If you cannot answer those questions, then the product may be private credit. But the real asset being traded is your ignorance. That sounds harsh. Good. It should sound harsh. People lose fortunes because nobody speaks harshly enough when the sales pitch still sounds polished. Now let us go deeper into the illusion itself. One reason private credit has seduced so many investors is that its reported volatility often looks low compared with the public markets. The line appears smoother, the ride appears calmer. This is where ordinary savers become especially vulnerable because they confuse a smoother chart with a stronger asset. But a smooth chart can be manufactured by infrequent pricing, subjective marks, relaxed, comparables, generous assumptions, and the simple refusal to ask what a forced sale would reveal. If I own something that nobody prices daily, I can tell myself many comforting stories about what it is worth. That does not make those stories cash. It merely delays the day somebody asks for proof. Public markets can be rude. I prefer that to private fantasy. When somebody tells me a portfolio of risky middle market loans deserves marks that look dramatically better than what more conservative lenders or public market equivalents imply. I do not assume they have discovered a sacred corner of finance where gravity no longer works. I assume the scoreboard has been placed in a room with bad lighting. That is why I have always preferred simple honesty to elegant opacity. I would rather hold a plain asset marked down in public than a romantic asset carried at par by committee. The first one hurts your ego, the second one hurts your future. And there is another trick inside this machine that you need to respect. When problems appear, labels begin moving. A weak software exposure can suddenly be described in a friendlier sector. Concentration risk can be softened with classification games. A company that cannot pay cash interest can be kept alive with payment. In kind structures that capitalize the unpaid amount and push the recognition of pain into some later season, that later season is always crowded with optimists who believe they will not be the ones left holding it. This is how hidden distress survives long enough to recruit fresh capital. Once you understand that, the social behavior around this market becomes easier to decode. Why are some people so eager to move retirement money into products average savers barely understand? Because the machine needs patient capital fee, bearing capital, non-questioning capital, and capital that mistakes restricted exit rights for professional prestige. Retirement money fits beautifully if the story can be made respectable enough. That should alarm you. The retirement account is not the place where you audition your appetite for opacity. It is not where you experiment with products whose return profile, redemption structure, valuation process, incentive chain, and stress behavior you cannot independently analyze. If you put that kind of product between an ordinary household and its old age, you are not enhancing retirement. You are importing a hidden tax into the one pool of capital many people cannot afford to rebuild. I want to make a distinction here because seriousness requires precision. I am not telling you that every private credit loan is fraudulent, every manager is dishonest, or every loss becomes a crisis. That sort of cartoon thinking belongs to amateurs. The world is more nuanced than that. Some private lenders are disciplined, some deals are structured intelligently, some borrowers are solid, some losses are manageable, some funds may come through this period looking merely bruised rather than broken. But that is not the test you should use as an ordinary investor. The test is not whether some professional somewhere can make money in a complex illiquid market. The test is whether you should surrender your capital to a product whose return profile, redemption structure, valuation process, incentive chain, and stress behavior you cannot independently analyze. Those are different questions. And most people answer the first question in their heads while putting money at risk on the second one. That is how traps work. Traps do not have to lie completely. They only need to move your attention away from the decisive fact. In this case, the decisive fact is simple. The locked door machine behaves beautifully until too many people want their money back. Too many borrowers need mercy. Too many marks need interpretation, and too many intermediaries need the story to remain attractive one more quarter. That is what creates the slow motion quality of the danger. This is not necessarily a one-week bank panic. It can be worse in a different way. It can be a long, grinding realization that the reported values were too kind. The liquidity was too conditional, the advisor incentives were too dirty, the underlying borrowers were too levered, and the structures connecting funds, banks, insurers, and retirement vehicles were more intertwined than the marketing copy implied. Slow problems are especially dangerous because the public does not know when to panic, so it stays passive longer than it should. Then there is the insurance angle, which should bother any serious allocator of capital. Insurance balance sheets are supposed to be about durability. They are supposed to be built to pay claims in bad times, not to become laboratories for clever repackaging. Yet financial engineering has a way of showing up wherever regulation creates a difference between the economic reality of risk and the official treatment of risk. If you can take a risky exposure, pass it through a special wrapper, obtain a Kinder label, and suddenly slash the capital that must sit against it, people will do it. They always do it. Finance never wastes an arbitrage of perception, and that is what makes me nervous, when risk is not being reduced but merely redressed for regulatory or marketing purposes. The system becomes more polite and less honest at the same time. Investors, insurers, advisors, and sometimes regulators all end up participating in the same fiction, each for their own reason. One wants yield, one wants fees, one wants smoother metrics, one wants capital efficiency, one wants a cleaner sales story. Nobody wakes up and says, let us build a fragile structure. They simply make a series of choices that reward appearance more than resilience. That is how fragility enters, dressed as sophistication. Now let me tell you what ordinary people consistently miss about these episodes. They think the danger matters only if it becomes another 2008. That is the wrong standard. You do not need a replica of the global financial crisis for private credit to do serious damage. A direct repeat is not required. Banks today are better capitalized than they were then. The old deposit-funded toxic chain is not identical, but contained does not mean harmless. A market can avoid destroying every checking account in America and still inflict huge damage on retirement savers, insurers, lending conditions, and the real businesses that depend on credit to function. You must stop thinking in cinema. Not every financial injury announces itself with dramatic collapse. Some of the worst ones arrive as lending standards tightening, refinancing, windows shrinking, redemptions being rationed, valuations drifting downward one committee meeting at a time, and middle market businesses quietly losing access to the capital that kept payrolls moving. If enough of those businesses sit at the center of employment and private sector output, the pain does not stay in a conference room. It moves outward. Less lending becomes less hiring, less expansion, more defensive behavior, more margin stress, and more economic hesitation. That is how a hidden credit problem becomes a Main Street problem. Again, you do not need a giant explosion. You need a sufficient contraction in willingness to extend fresh money. That is all. And when a market has spent years training investors to believe that yield, smooth marks, limited losses, and curated liquidity can coexist, the adjustment from fantasy to discipline can be brutal, even if it remains technically orderly. The ordinary saver needs to develop what I call scoreboard discipline. Scoreboard discipline means you do not let anybody sell you a return stream without showing you how and when reality gets to speak. If the answer is that reality speaks only quarterly softly, through manager discretion while redemptions are gated and advisors are paid more to recommend the product, then you do not have a scoreboard. You have theater, and theater is not where retirement money belongs. The second thing you need is refusal power. Refusal power is one of the most underrated forms of financial strength. If you feel pressure to own something because everyone important seems to own some version of it, you have already lost the psychological battle. Wealth is not built by matching the complexity of institutions. Wealth is built by understanding where you have an edge and where you do not. I do not need to participate in every fashionable structure to compound capital. Well, I need to avoid permanent stupidity. That principle has protected me far more than brilliance ever could. You should apply the same rule if a product requires you to ignore ugly incentives, uncertain marks, conditional liquidity, sector relabeling, payment, in-kind patches, opaque collateral quality, and the possibility that the people closest to the structure know more than you by several miles, then your correct response is not curiosity. Your correct response is refusal. People hate that answer because refusal feels unsophisticated. I think the opposite. The most sophisticated sentence in finance is often no, no. I do not need higher yield badly enough to accept lower visibility. No. I do not need access badly enough to surrender control. No. I do not need a smooth reported line badly enough to tolerate soft pricing. No. I do not need a quarterly redemption feature badly enough to pretend it is real liquidity. No. I do not need an advisor to place me where the advisor's compensation is doing half the talking. No, I do not need to import a shadow banking structure into the capital that is supposed to defend my old age. That is adult investing. Adult investing is less about finding magical assets and more about refusing seductive errors. The world will always create new wrappers for old appetite. It will always rename leverage. It will always perfume illiquidity. It will always reward those who can make risk look refined. Your job is not to memorize every new product. Your job is to keep a stable internal filter. I call that filter the daylight test. If a structure only works in dim lighting, I do not want it. If the marks look great only because nobody is forced to test them publicly, I do not want it. If the exit rights depend on other investors staying calm, I do not want it. If the pitch relies on my admiration for exclusivity, I do not want it. If the recommendation is inseparable from a heavy commission, I do not want it. If the manager's story sounds smoother than the borrower's economics, I do not want it. If the product is being rolled out to the masses at the precise moment the smarter money is becoming more selective, I definitely do not want it. That is not cynicism. That is hygiene. And hygiene matters because the temptation here is powerful. You will be told that the public markets are noisy. True, you will be told that private structures can offer higher income. Sometimes true, you will be told that long-term capital can harvest illiquidity premiums. Also true in some cases, you will be told that average savers deserve broader opportunity. Nice sentence. But none of those truths erase the central fact that a product can be economically fragile while remaining cosmetically composed. The locked door machine depends on you focusing on the composition and forgetting the lock. I am not willing to forget the lock, neither should you be. You should especially not forget it at a moment when broad economic conditions are no longer providing the kind tailwind that made many sins easier to hide. Levered middle market borrowers do not enjoy slowing growth, higher funding costs, stubborn inflation, squeezed margins, or energy shocks. They do not become more robust because the marketing deck still uses calm colors. They become more vulnerable. And when the borrower base weakens at the same time the end investor becomes more redemption sensitive, the machine starts feeling pressure from both ends. That is when the hidden design flaws matter. This is the point where many people ask me the comforting question, is it really systemic? I understand the instinct. People want a category. They want to know whether to place something in the box marked nuisance or the box marked catastrophe. But I think that framing can become an excuse for laziness. A thing does not have to be globally systemic to be personally ruinous. It does not have to erase the banking system to sabotage a retiree. It does not have to crash every market to expose that a supposedly conservative allocation contained far more theater than safety. Your portfolio is not saved by the fact that someone else's portfolio also lost money in an orderly way. So, do not ask only whether the world survives. Ask whether your capital remains under your control. In assets whose economics you understand, with liquidity that is real, marks that are honest, and incentives that do not require a translator. That is the right question. I will go further. This whole episode is a reminder that the line between investment and consumption is often psychological before it becomes financial. People think consumption is buying a car you cannot afford or a watch that signals status. That is one form. But there is another form that hides inside portfolios. When you buy a product because it makes you feel sophisticated, included, advanced, or protected from the noise of ordinary markets, you may still be consuming. You are consuming a story about yourself. You are consuming the identity of the person who invests in special things. That kind of consumption can be far more expensive than a vacation because it dresses itself as prudence. I have no interest in paying for that identity. I would rather own plain things I understand than impressive things I cannot interrogate. Simplicity is not a handicap in investing. Simplicity is often what remains after all the incentives have been cleaned off. If you remember nothing else from this, remember the machine. Remember that some systems are designed not to eliminate risk but to slow your recognition of it. Remember that some doors are visible only until too many people touch them. Remember that some marks are stable only because reality has not yet been granted a microphone. Remember that some products are sold hardest precisely when they should be examined hardest. Remember that some investors become exit liquidity for a market they were told they were privileged to enter. And remember that the average saver does not get rich by entering every room rich people built. The average saver gets rich by avoiding the rooms where the lighting, incentives, and exits do not make sense. That is the choice in front of you. You can keep chasing yield that flatters your impatience, hand your retirement to structures you cannot truly audit, and hope the locked door does not matter until after you leave. Or you can decide that your capital will only live where daylight, liquidity, incentives, and economics line up cleanly enough for you to explain them to a child. One path makes you feel sophisticated now and powerless later. The other path may feel boring now, but it preserves the one thing finance keeps trying to steal from ordinary people: control. And if you still think control is less important than yield, then you have not yet understood what the machine is for. It is not built to make you rich. It is built to keep you calm long enough to stay inside.